Hey, Puppy Trades! I wanted to do a video analysis update of the consumer discretionary sector. Now, I know what you're thinking. Puppy Trades, the market's up, 1.3%. You're coming out making a YouTube video on these popular stocks. You're a guru. I get that. So, first, let me get into some risk management. I recently bought, and this is not the full, you know, this is not the full pantheon of my risk management. And the whole point I'm making this video is to try to make the videos a little shorter, focus on one topic. But I did buy recently a long guts position on an ETF called PSQ that expires January, I believe, 19th of 2024. So PSQ right now is it's an inverse ETF on the NASDAQ. So it does the opposite of the NASDAQ by -1. If the NASDAQ goes up 2%, this goes down 2%. Ideally, that's the fund's goal. So I bought a long guts position on that. It was around 12.50 when I bought the 12 put on that ETF that expires in January 2024. And I bought the 11 call on that ETF that expires in January 2024. The reason I bought that is because of this idea called Delta Dollars exposure. So let's just focus on that call leg of that long guts position. So a long guts position consists of a call and a put where both options are in the money. So I bought the 11 call and the 12 put on PSQ while PSQ was around 12.50. So I wanted that higher delta on the call leg. So I believe the call leg was around, a delta of 0.80. I multiplied 0.80 by around 12.50. I got a value close to about, $2,200 in upside exposure to PSQ, which does the opposite of the NASDAQ. So that whole position, the call and the put on that ETF, cost about $255 for me to buy yesterday per lot. And each of those lots gave me close to $2,200, $2,300 in downside exposure to the NASDAQ. It also gives me upside exposure to the NASDAQ, which is something I'll get into in later videos. But here is my analysis of XLY. It's the consumer discretionary ETF. There's some stocks in this video that aren't in this ETF but are generally pretty fairly considered consumer stocks. So here's XLY. I think this is a large wave 1 subdivided into 1, 2, 3, 4, 5 waves. Now we have this wave 1, and if we look at the RSI, the weekly RSI here, there's an Elliott wave rule, kind of a little cheeky kind of under the radar rule. A lot of you got to be experienced to know this one. It's a little more of the voodoo ones, but if we look at the RSI, there's a rule that says wave 5 must end with momentum divergence. So we look at this this cycle that begins from this March 2020 low. We have 1, 2, 3, 4, 5 waves up, and the RSI makes a new higher high on this chart, and that suggests from an Elliott wave perspective that this large impulse right here isn't a large wave 5. All that means is that when I'm analyzing the chart, I'm expecting that there's going to be another high in this chart because the sequence has to end with a wave 5. Ideally, it will one day end with a wave 5 that makes a lower high on the RSI. So if that rule sounds silly, let me just finish this chart real quick. I'll show another example of me using that silly rule recently, but this is a large wave 1 and an ABC wave 2 correction at the 61.8% retracement. So 110 is pretty wide. We're going to get into other components of this ETF that do a better job defining risk. 126 isn't bad, $20 away for a stop. 110 would be a wide invalidation. I would call 126 a little bit of a tight stop, and I'm expecting this is a large wave 1 and a large wave 2. The length of wave 1 placed at the wave 2 low gives ultimately a wave 3 target, what we call an equal legs target, that can take XLY up into the 250s. Now, an example of me using this rule recently, and it hasn't quite worked out entirely yet, but it's getting there, is the semiconductor ETF SOXX. So looking at this ETF for a while, I had noticed that if we looked at the all-time chart, the monthly chart of this ETF, we had, over 20 years of chart history. And this large, rally, this large impulse was the highest reading this ETF had made on the all-time chart. That suggested, in the big picture, that this peak right here wasn't some type of large wave 5. All it means, all it kind of hints at from an Elliott wave perspective, is that there's another high to be made in the big picture. One example, I'm doing this right now with with my own moolah, is Mid America Apartments. If we look at this long-term chart, we again see this peak that's put in on this chart. The monthly chart is the highest RSI reading ever. Now, that's not some, special magical rule that I can call Ally Invest and say, hey, well, Mid America Apartments, made a higher high on this monthly RSI. It's going to, make a high again one day. Please don't margin call me. They're not going to like that. Let's talk about Tesla. I talked about Tesla in the long term a lot. I wanted to focus on the short term in this video, but in the long term, I do own Tesla, and I've bought in Tesla and OARK recently. Those aren't the only stocks and ETFs I bought, but they do collect a good amount of premium. And when, especially, when it's considered that these ETFs, were, debuted when, growth and, ARK and Tesla were kind of down here, doesn't necessarily mean it's the bottom or anything, but, the yields are pretty high on Tesla and OARK. Now I'm excited. I think the pay date on those dividends is coming up. But in the big picture, I've thought that Tesla is a large wave 1 and ending an ABC correction between the 61.8 to 78.6% retracement. If we zoom in, though, I think that this chart on the daily chart gives a pretty good example of what bulls can look for. So the idea, in the bullish scenario, is that this is a wave 1, an ABC wave 2 correction. And then in the short term, there is the possibility that this is another wave 1, this is another wave 2, and Tesla very tightly is going to hold above 163.91 and go on a wave 3 that can take it to, plus 280 in the big picture. Now, that would be a daily chart target. That's not, in the monthly picture, there's more than that going on. I'm focusing on the short term in this video. So I'm not going to sell Tesla or Tesla if it goes below 163. But I do want to show that even if it did, I hope I had this right here. Even if Tesla did go below 163, what the bulls would argue is that this is simply an ABC correction from this peak. And so this wave 2 would then be ending, or bulls would be looking for this wave 2 to end around this equal legs target down here, in the mid 150s. And the bottom line is they'd still be looking for, a pretty nice wave 3 to begin. Now, that's, if I had to pick one, and I'm not really the short-term, trader. I'm in Tesla for the bigger picture. I would be excited to buy, some bloated option premiums when I'd be excited to sell some bloated option premiums when Tesla's implied volatility was real high. If it did have another, scary alert slower, I'm not betting on that. I don't think, if I had to pick, that's going to happen. I think this is, if we look around XLY, which is what I'm doing in this video, we can see on the daily time frame, whether it begins from here or from here, I'm expecting Tesla to make a, in the daily perspective, another thrust up into the upper 200s. Here is Starbucks in this sector. It's really led this sector a lot. And if we look right now, It's a 1, 2, 3, 4, 5 waves up. An ABC correction at the 61.8%. It's a 78.6% retracement. There's a few ways to subdivide this rally from this low, but I'm more interested in the possibility that we could see Starbucks, I hate to say it, but Starbucks is $20 away from breaking this high. I mean, if Caterpillar, breaking the 2021 high was a leading indicator, and in-phase energy and First Solar exploding above 2021 highs was a leading indicator, then Starbucks right here breaking above this high would be a big leading indicator, especially for the sector. In the long term, there's a few ways to subdivide this, but ultimately, bulls are going to be looking for, Starbucks to be within this wave three, making its way to this equal legs target for wave three, found by taking the length of wave one, place at the wave two low. That could take Starbucks up to the 140s. And it kind of reminds me of another chart. I'm just going to keep holding Starbucks. It was one of my, fortunate buys, in the low 80s. I bought it for the dividend, but it kind of reminds me of Oracle, where Starbucks and Oracle very quietly, we're no longer talking about, Caterpillar or, consumer staple stocks. I mean, we be talking about a big software stock and a big consumer discretionary stock breaking to an all-time high, participating in this correction with a lot of the market. And for me, I think a lot of bulls are going to see Oracle break above this high, and they're going to start looking for other software stocks in this area. But anyway, that wasn't supposed to be. This wasn't a software video, although I do suppose Amazon's technically a software related stock. I think this is a large wave one for Amazon, subdivided into 1, 2, 3, 4, 5 waves. This is an ABC correction, ending wave two at the 78.6% retracement above 81.30 to 81.43. The length of wave one placed at the wave two low can take Amazon up into the 200s, and that would actually be a minimum wave three target. So I know, it's a big green day. Someone's talking about Amazon, doubling, but that would just be, only a marginal new high above this high from this area. I think for Starbucks and for Amazon, and quite frankly for Tesla too, looking for a wave three breaking an all-time high. It'd be a nice gain from these lows, but it wouldn't be the full length of what this could become in this sector. For a lot of those, making a new marginal all-time high would just be the minimum wave three target. We could see a shallow wave four and a wave five higher. We'll get there when we get there. Here is kind of the home building, more, I would say, inflation focused side of this sector. This is Home Depot. I think from the daily chart, this is a wave one and a wave two. We can see that it's ending an ABC correction from this low. I believe it formed another wave one, and it's ending a wave two with the ABC correction. If we take the length of wave one, we place it at the wave two low, then we can see Home Depot enter a wave three on the daily chart. Pretty much the same invalidations from both cycles: 265.61, 264.51, wave one, wave two, another wave one, another wave two. Home Depot can enter wave three of wave three, and that would take it to, into the 360s for a minimum wave three target before a shallow wave four. If wave four retests the wave one high and wave five is the length of wave one placed at the wave four low, we could see Home Depot go up into the 400s, the lower 400s, call it 420, for a 1, 2, wave 3, 4, and 5 waves up. We see some consolidation, and then another leg higher. So I think this is wave one and wave two. This is another wave one and another wave two above 265. Home Depot can enter wave three of wave three. The first minimum wave three target would be above 360 before a shallow wave four and a wave five higher. If wave four retests the wave one high, wave five is the length of wave one places the wave four low. Just within the cycle from this low in September, we could see Home Depot go all the way up to about 420. If we look at lows, very similar idea. Obviously, a very related name in this sector, both kind of in the, dividend growth, idea of this area. If we look at lows, zooming in on the daily chart, I think that this is haven't updated lows as much as I thought I had, but if we look at this chart from this low, I think it's ending an ABC correction from this high, and we can see um, lows enter a wave 3. So I think I can do these extensions right there. There we go. If we look at a wave 3 target for lows, it's the 161.8% extension of wave 1. So I'm going to move these numbers out here a little bit. 220, we'll call it 220. This is 170.12. All right, we're going live. 170.12 for lows. I think it's good to go live. You guys can see kind of, what I'm doing while it happens. Making shit up. I'm just kidding. 221.19 is this high. So if we look at this bigger cycle, this is a wave 1 and a wave 2, ending between the 61.8 to 78.6% retracement. I think above this wave 2 low of about 176, we can see lows enter a wave 3 on the daily chart that takes it all the way up to 252 before a shallow wave 4 and a wave 5 higher. If wave 4 retests the wave 1 high and wave 5 is the length of wave 1 placed at the wave 4 low, then that kind of longer, bigger picture wave 5 target could take lows up into the 250s, even the 270s. If we look kind of from this low, this kind of similar to, I think, Target, which we're about to go over, similar to Home Depot, which we just went over, could be another wave 1 and another wave 2 forming this low from this low. And we can see lows enter wave 3 of wave 3, 276.50 is a nice invalidation for the daily chart. 183, 178.71 would be a little tighter. Here is where I did Home Depot. Here is RH Restoration Hardware. Definitely, I don't think this is an XLY. Kind of related to, kind of this furniture home building idea. I guess if we look at the all-time chart, this is a stock that's rebranded. It used to be called Restoration Hardware. I think this is a large wave 1 or wave A. This is a wave 2 or a wave B, ending between the 61.8 to 78.6% retracement. The main idea is that this is 1, 2, 3, 4, 5 waves up. So whether it's a wave 1 or a wave A, and this is the ABC correction, whether this is a wave 2 or a wave B, the minimum target for wave 3 or wave C would be the length of wave A/wave 1 placed at the wave 2/B low. And that's why the equal legs target is, kind of pretty important to a lot of Elliott wave theorists. Certainly me. The length of wave 1 placed at the wave 2 low, or the length of wave A placed at the wave B low, says that Restoration Hardware could begin a long-term wave 3 up above this all-time high. Even 744 is, would be plenty reward. I think 178 is a great downside level to be above. But I know the bigger numbers sound more outlandish, but the length of wave 1/wave A placed at wave 2/wave B says RH above 178 can go all the way up towards 900. Here's Ford and GM. I don't think these auto stocks are in XLY, but they're generally considered, kind of consumer related names. If we look at both of these, I think that I might have the weekly chart. Ooh, in the weekly chart, those fibs were right where I needed them to be, 25.87. So I'll move these in. I think for Ford, this is a wave 1, subdivided into 1, 2, 3, 4, 5 waves. This is an ABC correction. Ending wave 2 between the 61.8 to 78.6% fib. 8.65 is a little wide, that 78.6% retracement. But I do think that Ford is ending, a big wave 2 correction, and it can begin a wave 3 with General Motors, which I'll get into next. The length of wave 1 placed at the wave 2 low says that Ford can enter a wave 3 from the cycle. That equal legs target would be about, 30-ish, right? That's a long way away. That's why maybe that wider level of 8.65 might be might be useful. If we look at this weekly RSI again, we have another example of that RSI rule, where from the cycle we have 1, 2, 3, 4, 5 waves up, and this rally makes a higher high on the RSI. All that suggests, all that hints at, is that this larger cycle isn't a large wave 5. I suspect it's a large wave 1 and a wave 2, because we ended the 61.8 to 78.6% retracement. 8.65 is a little wide, but we can enter a wave 3 all the way up to 30. Similar idea with Goodyear Tire in this auto sector, where we've got clearly 1, 2, 3, 4, 5 waves up, an ABC correction between the 61.8 to 78.6% retracement. I think a little wide would be 7.28, a little tighter would be 8.48. This is kind of more evidence for the auto sector, reminding that Tesla is an auto stock, by the way. So is NIO, which I covered in my last video, but a wave 1 and a wave 2 above those levels. Goodyear Tire also suggests with Ford, it can make a run, 200% higher in the big picture. Here is General Motors, another kind of, obviously quite related to Ford in the auto sector. If we look at this stock, very similar idea. A large 1, 2, 3, 4, 5 waves impulse to form a large wave 1, an ABC correction between the 61.8 and 78.6% retracement, and then forms another wave 1 and another wave 2. It can begin a wave 3 above 25.64. The length of wave 1 placed at the wave 2 low suggests that General Motors, that equal legs target is all the way up there, in the 80s, in the big picture. I know that's far away, even just getting above 67 would be a substantial gain, but it just kind of, defines the risk from an Elliott Wave perspective of what can happen in the auto sector. Last one, Disney, almost certainly not in XLY. I think I meant to go over Target too in this video, so maybe this isn't the last one, but a large 1, 2, 3, 4, 5 waves up, grand super cycle, wave 1 for Disney and a wave 2. All that means is that there's a lot of reward above this March 2020 low. I know that's a common theme. I know some of them have broken, but 79.07, that's the invalidation that this is wave 1 and wave 2. If that level holds, wave 3 of wave 3 says it's not just going to be, oh, duh, it's going to be, oh, shit. Anyway, that's how I would have ended the video, but I want to talk about Target. Target has a pretty little dividend, sometimes it's, oh man. So there's a few ways to look at Target. There's a conservative way to look at Target. So let's talk about the conservative way to look at Target just for right now. Pretend those red numbers can't be seen. It would suggest that this is 1, 2, wave 3. We're ending an ABC wave 4 correction, and we'd see Target make a marginal new high in the long term, and that would be a wave 5. So it would be 1, 2, 3, wave 4, and wave 5. I think that for Target right now, 130 is a nice level to be above. But if we look at the long term, it's a little tight, but 137 has pretty nice risk reward for this, kind of stock, where I think I charted the daily a little more in depth in a prior tweet, but it's a similar idea to even Amazon, where it's formed a small wave 1 and wave 2 from this low. It can enter, a large impulsive wave to the upside. Now, the conservative expectation would say that wave is a wave 5. This is 1, 2, wave 3, wave 4, and wave 5. One reason it may not be is because this kind of deeper, more dramatic ABC correction, the stereotypical wave 4 is a triangle. It's kind of sideways. It's kind of boring. A lot of times when it gets really dramatic like this, we have a, deep, ABC correction to the 61.8% retracement, 78.6% retracement. A lot of times in Elliott wave theory, that fits the, description of a wave 2. So that would also open up the idea. This is a wave 1 and a wave 2. This is another wave one and another wave two. It all goes to say that above 137, there's a lot of RR for target. It could be going, up into, beyond an all-time high, into the 300s in the big picture.